If you don't understand liquidity, you are the liquidity. Yes, guys, liquidity is that important. In fact, prices bounce around like a ping-pong ball from one liquidity zone to another. If you can identify these areas, you'll definitely make some good trades, otherwise, you will become liquidity for successful traders. Let's take a look at some of the most important ones together. If this sounds valuable, please like this video and subscribe for more insights. So what exactly is liquidity? Liquidity refers to the amount of money and orders present in the market. Key liquidity levels are areas on a chart where there is a high concentration of buy and sell orders. These levels can significantly influence price movements, acting like magnets that attract price action. Essentially, liquidity is where retail traders engage with the market. Actually, liquidity is like a rubber band. Market goes in opposite side to took liquidity, and after taking liquidity it aggressively goes in desired actual direction. There are two types of liquidity: buy-side liquidity or BSL and sell-side liquidity or SSL. Buy-side liquidity levels are found at market highs and refers to the levels on the chart where short sellers have their stop losses set. Sell-side liquidity levels are found at market lows and refers to the levels on the chart whereby sellers have their stop losses set. Imagine this line chart as the market movements. When the market sentiment is bullish, sell-side liquidities are more important than buy-side liquidity, because sweeping the liquidity below these lows often signals a possible bullish continuation and creates an opportunity to go long in line with the dominant trend. So, the question is, where are the liquidity zones? Let's discuss the main types of liquidity you should identify on your charts. Number 1 is equal high and equal low. Okay, what are equal highs and lows? Equal highs and lows occur when the price reaches similar low points, equal lows, or similar high points, equal highs, on a chart. Equal highs and equal lows, often identified as double tops and double bottoms in classic technical analysis. These levels are key indicators of market liquidity, serving as identifiable points of supply and demand. When we identify equal highs, we see supply. Conversely, equal lows indicate demand. Retail traders often place stop-loss orders just above these equal highs or below equal lows, anticipating potential reversals, which means we'll have an additional layer of liquidity here in the form of buy stops or sell stop for breakout traders who expect to buy or sell when the market breaks out. This practice underscores the idea that significant liquidity exists at these levels, which can attract large capital flows. These levels act as a gravitational force, attracting large capital flows and creating a significant amount of liquidity. In this example, a strong downtrend has created equal highs that act as supply. Above these equal highs is a significant amount of liquidity because many traders sell here and put stop loss here. But what I see is a liquidity that has an FVG above it that can reverse the price. Look for fair value gaps that act as supply areas just above the liquidity zone. A good trading setup would be to wait for the price to break below the equal highs, collect the liquidity, and then go short at the FVG zone. The combination of FVG with equal highs and lows creates a setup with a high win rate and very good reward. In fact, this is one of my favorite setups. Okay, one of the liquidity level are swing highs and swing lows. Swing highs and swing lows are important concepts in trading. Swing high is 3-candle pattern where the middle candle has a lower high on both sides. Swing low is 3-candle pattern where the middle candle has a higher low on both sides. You can recognize these patterns after 3 candles close. It's also possible to use a 5-candle pattern for more reliable swings. Understanding the psychology behind these swing points is crucial. For instance, if a trader wants to buy at a swing low, they are likely to place their stop loss just below that level to protect against market fluctuations. Conversely, a trader looking to sell will typically place their stop loss above the swing high. Breakout traders will enter positions if these swing levels are broken. This means that buy-side liquidity is often located above swing highs, while sell-side liquidity is below swing lows. In a bullish scenario, if you are optimistic about price increases, observing swing lows forming before reaching a demand area can confirm potential bullish movements. This indicates that the market is gathering enough liquidity to support future price rises. If it doesn't accumulate sufficient liquidity, it may drop lower to collect more sell-side liquidity before continuing upward. If you anticipate price declines, seeing swing highs forming as the price approaches a supply zone can signal a good trading opportunity. By understanding and marking these liquidity levels, you can make more informed trading decisions. One of the swing highs and lows liquidity types is trend line. Essentially, trend liquidity refers to areas where we expect a high concentration of orders. Retail traders often subscribe to the idea that a trend line represents a potential change in trend. The traditional approach is to wait for a retest of the trend line to sell or to look for a breakout and then a retest to buy. Let's break down the price action. Here, we can see a shift in the trending structure. We formed a high, followed by a lower low, then a lower high, and finally another lower low. This indicates that unless we break above the previous high, the trend remains bearish. A break of the trend line doesn't necessarily mean a trend reversal is imminent. With this understanding, we can focus on following the trend. Any movements around the trend line become context for liquidity rather than indicators of trend changes. So, what do we know about liquidity at this level? First, we have sellers at the trend line, which constitutes our first layer of liquidity. These sellers will likely have stop-loss orders placed just above the trend line. Next, we have breakout traders who are anticipating a push upwards, creating a second layer of liquidity with buy-stop orders. Lastly, there are manual execution buyers looking for a break and retest, adding a third layer of liquidity above the trend line. So, what's likely to happen? Often, the market will sweep through these liquidity zones, triggering stop losses and buy orders, only to reverse direction and move back down, liquidating buyers who entered after the breakout. This means that both sellers looking to sell the retest and buyers looking for a breakout can end up losing. So, how can we leverage this information in our trading? First and foremost, don't blindly trust trend lines. Instead, focus on the actual price action, specifically, the highs and lows. Remember, a trend line doesn't dictate the trend, it simply highlights areas of liquidity that could trap you into losing positions. To trade trend lines and trend liquidity effectively, always consider the underlying structure. As we've discussed, unless the previous high is broken, the trend remains unchanged. Additionally, keep an eye on supply zones, as they can provide further insights into potential price movements. Another liquidity level are turning points. Turning points are areas on a chart where the price changes direction after a long-term trend. These levels are often seen as overbought or oversold, increasing the likelihood of a price reaction when revisited. They hold significant liquidity because they attract attention from both retail and institutional traders. To effectively use turning points in your trading strategy, look for areas where the price has sharply reversed in the past. These levels are likely to hold clusters of stop-loss or pending orders. Look for a spike beyond the turning point, which indicates that stop-loss orders are being triggered. This is often followed by a sharp reversal. After the liquidity sweep, wait for confirmation of a reversal, such as a strong bullish candlestick or a change in market character. Once a reversal is confirmed, enter the trade in the direction of the reversal. Place your stop loss just beyond the liquidity sweep to protect your position from unexpected moves. By following these steps, you can effectively incorporate turning points and their associated liquidity dynamics into your trading strategy. Next liquidity level are daily highs and lows. Daily high is the highest price reached during the day. Daily low is the lowest price reached during the day. These levels are crucial because they attract significant attention from traders, leading to many stop-loss and pending orders being placed around them. When the price approaches the daily high, it may briefly move above it, triggering stop-loss orders from sellers. This can activate buy orders, causing the price to drop back down. Similar behavior occurs near the daily low, where stop-loss orders from buying trades may get triggered. Start by marking these levels on your chart and watch how the price reacts when it approaches these levels. Often, there will be a brief breakout followed by a reversal. Check for additional signals, such as a change of character, reversal patterns, overall trend direction. Once you see a reversal after a breakout, enter the trade in the new direction. Place your stop loss just beyond the breakout level to protect your position. Target the next key level on the chart, such as a support or resistance area. Alright, that's all for this video. Learning to spot liquidity zones can seriously change your trading game. If you found this helpful, give us a like and leave a comment to show some love.